everyone. This is Tim Leveroni. Joining me today is Lee Generous. We want to thank everyone listening to this market update call. Our goal is to educate you on the market environment and share perspectives from some of the investment managers we recommend. Shortly, I will introduce our speaker, Jeff Bookbinder. He will present LPL Financial's outlook on the current market environment. If anyone has any questions, please call or email us. Jeff Bookbinder is Vice President, Equity Strategist, and Portfolio Manager at LPL Financial Research. Okay, Jeff, take it away.
All right. Thank you so much. Good to be with you all. Again, some of you may have heard from me before. Before I get started, just want to remind everybody this call is being recorded. Thank you, Tim and Lee, for the invite. Looking forward to walking through our latest thoughts on the markets here in 2020. The Outlook publication, which I'm sure many of you have already seen, is a few months now, so I'm really going to try to focus my comments on what's new here. I guess what's not new is uncertainty. Coming into 2020, the uncertainty was really focused on trade and U.S.-China relations. That's cleared a bit with the trade deal, and now we unfortunately have a new uncertainty here, which is the outbreak of the coronavirus. New cases have been slowing the past few days, so that is certainly good news, and certainly the stock market is reflecting some comfort that this will be contained and not have any more impact on the global economy than it already has. We certainly have election uncertainty still as primary season gets underway. That will be with us for several more months. And then uncertainty around, just whether this economic expansion can continue. So the theme here of 2020 is clearing uncertainty. You see here on the next slide our forecast for 2020. Just high level, we think, U.S. GDP growth can make a run at 2% now. When we made this 1.75% forecast for GDP growth, we hadn't gotten the trade deal yet. So trade uncertainty certainly caused us to be a little bit more cautious. And then, there is a chance after the election that we get a modest recession, so we wanted to factor that in. So probably a little bit more conservative than others might be here, but let's just say about 2% GDP growth in the U.S. is a reasonable target, and that puts us around trend. Overseas growth a little bit slower, maybe a little bit more uncertain, but probably around 1% growth in Europe and Japan, and then the rest of developed international may be a little bit better to get us up closer to that 1.5. We do think emerging market economic growth, a lot of that is China, and certainly a lot of Latin America and the rest of Asia in there as well. We think that growth profile can be a little bit better than developed international economies, although this is where the coronavirus outbreak hits hardest. So there is some downside risk to that. Nonetheless, we still see emerging market economic growth picking up a little bit from what we saw last year. And that leads us to our global outlook, where we think 3.5% GDP, in line with what we saw last year, is doable.
So Jeff, this is Lee. A couple of things as we take a look at this slide. Obviously, it was forecast for 2020 at the beginning of the year, and we've some things that we'll just say have evolved since then. But as we take a look at this slide, two things that I guess come front to mind for me is, number one is, as you indicated, LPL's forecasts are probably a little bit more on the conservative side and certainly far below what the current administration is projecting. And then looking at interest rates as well, when we look across the industry and speaking with different portfolio managers and economists, we're hearing a lot about yields continuing to trend downward. So as we look at this slide, on the equity side and the GDP side, it seems like we're being pretty conservative, whereas on the the yield side for fixed income, are we undervaluing or underestimating the potential for yields to continue to drop?
Yeah, both good questions. I think the bond market is being a little bit more cautious right now than the stock market. I think that's clear. I would say our GDP forecast certainly is more conservative than our yield forecast. I think it's fair to say that yields have been more distorted by external forces, quantitative easing, right? What the central banks are doing around the world certainly is part of that. Bond yields have reacted a lot to the coronavirus, certainly a lot more than stocks have. So we would just say the bond market's being a little bit more distorted by these factors than the stock market and the economy. And in fact, even if you want to be conservative with the virus impact, we can probably still grow, at a close to 2%, even with the impact that most economists expect from that outbreak, which really isn't having a lot of impact on the U.S. So, and then on the yields, just one more point, 50, 60 basis points of yields, to get us up to that 2.25 range is not a big move historically. So we still think that is achievable and would be more of a normal range, we would say, than the 1.6% where we are right now.
What would be the catalyst to get yields to rise from current levels?
Well, first, a little bit more wage growth, which is a big part of inflation. Unemployment's really low, job growth is pretty strong, which you'll see on a later slide. That can certainly help. And then a little bit more of a normalized environment in terms of monetary policy in Europe and Japan.
Is there even such thing anymore?
And then, well, yes, and here's where I'll go next. We have seen evidence that global growth is stabilizing, if not even improving a little bit. And of course, a big part of global growth is Europe and Japan. So if we do get better growth, as those leading economic indicators are suggesting, then that should lead to a little bit higher yields overseas, and the market should start to sniff out the end of this extraordinary, unconventional monetary policy overseas. So those are the key factors, I think, with regard to yield. Turning to the stock market and earnings, stocks have gone above what we think would be fair value at this point in time, but to us that doesn't mean sell stocks. We're maintaining our targets for equities and fixed income allocations. Fair value is kind of a guide, and stocks can trade above fair value or below fair value for an extended period of time. But we would certainly not dismiss the fact that valuations are clearly above average and may limit the magnitude of gains, over the next, call it, year or two. Last year we got the big increase in valuations. That means the price to earnings ratio went up. This year we think gains are going to be driven by earnings. And on that front, we think we can get mid to high single-digit gains in earnings, and that can lift stocks. Probably not going to be a big year for stocks, but we think we can get more out of this market. Modest economic growth and low inflation is a good environment for stocks. So next, I've got a slide on just GDP by quarter for the U.S. And you see here, we have slowed clearly. As I mentioned before, we have upside, we think, from the trade deal, barring any unexpected further impact from the virus outbreak. We expected growth to be better last year, but really the stimulus that was put in place in late 2017 that went into effect in 2018 was offset by the trade war. So now that we have trade clarity, we think we've got the potential for a pickup in business investment. You put that together with a very strong consumer that continues to spend, fully employed consumer with rising wages, and we think this economic expansion can continue, and again, we can get maybe 2% growth. So Quickly on inflation, inflation's really a non-story right now because it's been quite calm for an extended period. I alluded to wages, perhaps carrying the potential to lift inflation, but when you look at the rest of the story, it's really hard to envision much of a pickup here, and that's where this chart comes in. This is consumer prices in blue and producer prices in black, and you see here producer prices have rolled over, right? That inflation rate has fallen quite a bit, and that tends to mean that consumer prices are poised to decelerate as well. Well, we haven't seen that yet. So not only are wages contained, I'll show you that chart in a sec, but we also have producer price inflation slowing, which should lead to less pressure on consumer prices. So we're still in a very healthy 2% range, and we probably will be certainly for several more months. Turning to wages, this is where really the rubber meets the road for companies, right? The biggest piece of a company's cost is labor, and this is also the piece of inflation that scares the Fed most. And right now, right around 3% in the latest jobs report, we have basically been there for a year without any sign of a move higher into the what would be a more troublesome level, potentially 4% or higher. Historically, when you get wage growth at 4% or higher, that's when the Fed gets scared and has historically put some pressure on the brakes and tried to slow economic expansions. We're quite a ways away from that, which really puts us in sort of a Goldilocks scenario where the economy is not too hot, not too cold. We have enough wage growth to support consumer spending, but we don't have too much to where it would scare the Fed. Job market's still strong. We just created 225,000 jobs last month, which was very strong, much better than expected. And
Jeff, what expectations are only in the low to mid 100s, right?
Yeah, 150 to 160 was the consensus expectation, for Bloomberg and some other sources that we follow. So that was a huge upside surprise, and certainly, should bode well for the outlook here. Companies hiring, business confidence is clearly on solid footing. So let's turn to central banks here. I alluded to it a little bit earlier. The Federal Reserve is still pretty accommodative. Rates are still pretty low, even though they did raise them last year. But if you compare our rates to the international rates in Europe and Japan, we are much higher. And that's, it's important for several reasons. But one is it can put up upward pressure on the U.S. dollar. So the reason we put this chart in our 2020 Outlook publication is because of the dollar. We've added actually a couple more percent this year to the U.S. dollar index. It's been quite strong, and that matters because it's been a little bit of a hit to international market returns. So for those of you who have international mutual funds, for example, your gains have been clipped just a bit by a strong dollar. It also makes it more expensive for economies overseas to fund their debt, right? Because they have U.S. dollar denominated debt in many countries around the world, and if the dollar is really strong, their debt load effectively becomes more expensive to service. And then also, we know this from President Trump, the dollar is important for trade. And if the dollar is too strong, then that makes our exports more expensive, hurts our trade deficit, and certainly we've heard from President Trump a number of times, the reason he cares so much about the Fed and rates, or at least a big reason, is because of the dollar.
Jeff, isn't the dollar also used to price oil?
Absolutely, and gold. So when the dollar is strong, it can put pressure on commodity prices, and we've seen oil drop from essentially $60 to $50. That's partly because the market's saying China's not going to grow as fast because of the outbreak over there, but it's also because the dollar has been so strong. So, you know, it contains inflation. It makes our imports cheaper and drives our commodity prices down. So that's even another reason why inflation is not a concern here. We do think the dollar, though, is going to drop here before too long. There's still some secular forces pushing the dollar down. They've just been totally dominated by some of these short-term, you know, basically short-term tailwinds for the dollar, such as central bank stimulus and a little bit of a flight to safety during not just the trade war, but also the virus outbreak.
So Jeff, what are some of the things that LPL Research and your team think are going to cause the dollar to drop from its current levels?
Yeah, well, the biggest reason is the trade deficit and the budget deficit, right? When, you know, basically the world needs, the world effectively has a lot of dollars. And, you know, one of the reasons why is because we have a big trade deficit. And that should put downward pressure on the dollar. It should increase global demand for dollars and push dollars away from the U.S. So that's one reason. We also think that the gap in monetary policy should close, right? So, you know, the Fed's on hold for a year, most likely. You know, if we get unexpected deterioration in the economy, maybe the Fed cuts later this year. But you probably have a Fed on hold. And then maybe the market can start to sniff out, you know, Europe and Japan pulling back. You know, that might not be this year, but maybe in a couple of years. These markets are very forward-looking, right? And then hopefully with trade clarity, you know, protectionism is dollar bullish, right? If we have an improvement in the global trade environment, that can potentially be dollar negative as well as demand for international currencies increases. So those would be some of the main reasons. I mean, plus it's, you know, it's gone up so much so long, we just think it's a little bit out of its fair value range.
Kind of reversion to the mean, if you will?
Exactly. Exactly. So this is important to watch. We do think the dollar is poised to at least slow its advance and potentially reverse it. So let's turn to the bond market here real quick. The you know, the 10-year yield, we just talked about it. We think it can go a little bit higher. It's going, you know, we're talking about maybe 30 to 40 basis points, you know, 0.3 to 0.4% higher from where it is today to get to the low end of this range, potentially a little bit higher. And I mentioned some of the key drivers. We should see steady economic growth, certainly in the U.S. We should see a little bit better growth outlook overseas, and then we should see a tighter labor market later in the year start to put a little more pressure on wage growth, and therefore maybe the market sees a little bit more inflation ahead, gradually, but a little more. And all of those factors we think can put a little more pressure on yields. And by the way, with the, you know, I mentioned the deficit and the debt, that should eventually put a little more upward pressure on yields as well. You know, not because anybody's going to expect that the U.S. government won't pay its debts back, but nonetheless, the sort of you know, long-term outlook is potentially for the U.S. to have a little bit more trouble funding the debt, and you might see that creep into yields, you know, over the next year or two, and you know, probably not going to see this massive demand for treasuries globally that we've seen. There'll still be big demand for treasuries globally, but just probably not quite as strong as it's been over the past year or so.
Has the researchers team's perspective evolved at all in the last 30 to 45 days, given what's taken place during the first part of 2020?
You know, it might surprise you to hear this, but I would say no, Lee. The economic impact of the virus outbreak is expected to be contained to maybe a 2-3 month period, and then we would expect the impact on the U.S., the economic output that's lost in the U.S. to be recaptured in the subsequent few months. So, yeah, we've sort of delayed maybe the upward trajectory. The Q1 GDP growth number in the U.S. will be sub 2% most likely. It probably would have been over 2 otherwise. So there's a little bit of a delay in this trajectory, but we still think by the end of the year we will be at 2% on the 10-year, if not higher, and be at that roughly 2% growth rate in the U.S. that we have anticipated over the last couple months.
Okay.
So, the big story in the bond market last year was yield curve inversion, and we actually had a modest inversion last week on the 3-month 10-year Treasury spread. We've talked to you about this before. This is a good economic signal of recession historically, but this particular case of inversion is not as worrisome for a few reasons. One, it was a really short-lived inversion. We steepened right back last summer. We steepened right back this week. And so a short-lived signal is probably not as effective. Number 2, it is not a very deep inversion, right? It just barely inverted. This is where the 10-year yield falls below short-term yields, right? Like a 3-month yield or a 2-year yield. If it's a modest inversion, it's not as powerful of a signal. And then I mentioned we're distorted, and our bond market's being distorted by international yields being so low, or in some cases negative, right? And then finally, this signal has a long lead time. So even if it's a recession signal, it might be 2 years before it actually works. And frankly, even if I'm the most bullish on the economy, I still have to recognize that there's a chance in 2 years that the U.S. economy will go into a recession. It'll probably be modest. We don't see anything close to like 2008. There's just absolutely no basis for that, or even 2000. This is a very, very different environment. However, a modest recession in 2021, I think even the bullish folks out there would say there's maybe a 1 in 3 chance of that.
Well, Jeff, would you say that with yields as low as they are and the spreads so tight together that these inversions are going to become more frequent in nature? And could it possibly lead people to get a little numb to them?
Yeah, it's an interesting question. I would say that in a low interest rate environment, like we've been in for a while, a flat yield curve is probably a little bit more common, and therefore, yes, I think people will be quicker to dismiss them. It's kind of the new normal. Some of you maybe heard that phrase, right? It's just a very different environment for economic growth, inflation, and the bond market. So, yeah, I think the market will finally get this message. I mean, the stock market's already gotten the message, right? Because we're at, all-time highs again, and, added several percentage points to last year's rally, which was strong, despite the fact that we have these global uncertainties, a very pessimistic message from the bond market, the virus outbreak, still trade relations are tense, all of that. Stock markets look beyond it, which is encouraging. I think it's probably the right way to look at it. So speaking of the stock market, we'll just highlight the outlook. I mentioned again that we're a little bit above our fair value target, but that's a guide, right? We can stay above that for a while. We'll probably raise our target at some point here, but we're at about 3350, 3360 on the S&P 500. We think we can add maybe a few percentage points to that this year. But, after the strong year last year and at current valuations, probably going to be tough to get, another, mid-teens kind of year. That's at least where our heads are at this point. But again, the earnings story is pretty good. Earnings season's been excellent so far relative to expectations. The Fed is on hold, which stock markets like. And as we said, there's probably not going to be a recession anytime soon. So really a lot of these things are well aligned, low inflation, low interest rates to support the stock markets. So we still have a positive outlook, but we do recognize there are risks out there. Certainly the election is one. Rich valuations are another. And then if you do want to say that last year's strength means we can't do, we can't get much out of stocks this year, we would point to this study that we did in a recent blog. If you look at all the 30% years since World War II, 10 out of 12 of them were followed by up years. Right? That's the 10 out of 12 you see at the bottom of this slide. And then the average gain was mid-teens. So I just said it's going to be hard to get a mid-teens year. Maybe we get it. This study suggests we have a shot. If you look at the 2 years that were down after these 30% up years, they were both accompanied by recession. So can't emphasize enough how important it is to see the U.S. economy grow if you want gains in your stock portfolios.
Well, Jeff, as you've kind of alluded to, along with the U.S. economy growing, if earnings continue to grow and, outperform as they've have year to date, that could be, a driver of performance like that?
Absolutely. It's in the simplest terms.
Prerequisite, if you will, to get there?
Yeah, in the simplest terms, stocks have to go up either with earnings growth or the market pricing in higher valuations, right? It's the price to earnings ratio. Either the P, the level of the S&P 500 has to go up while the E, earnings, don't, or earnings have to go up and then you keep the PE ratio constant. So that's what we think is going to happen here. We think that, the P and the E are going to go up together. And, if we get mid to high single-digit earnings growth, we think we can get mid to high single-digit stock returns, and then you add dividend yield on top of that. Stocks appreciate, and then you get the dividend yield of about 2%, a little bit less than that, and you get, pretty solid high single-digit year. So that's a very realistic scenario here in our view. So, that's the next slide here, the earnings slide. I mentioned earnings are pretty good right now based on what we've seen during earnings season. Trade uncertainty's cleared, that's helped. Business confidence is improving, that's helping. And then the virus outbreak has actually not impacted earnings expectations all that much to date. Even companies that we heard from in just the last few days, which of course was well after this outbreak slowed business activity in China, companies are still generally optimistic. There are a few that are hit particularly hard by business closures in China. You've probably seen it in the news, but if you look at overall, the earnings from the S&P 500 are not impacted very much here, which is certainly good news. And normally estimates fall during earnings season. This time, the decline in earnings estimates for 2020 has been really modest, which is great news. So pretty good outlook for earnings this year. We're going to see better earnings growth, we think, in emerging markets than we're going to see in the U.S. So that's this next chart. I'll give you the up-to-date numbers. I just looked at this morning. Consensus expectations are for 7% earnings growth in the U.S. and 6% in Europe, a little bit less in the UK, similar in Japan. Emerging markets, 16%. So double the earnings growth expected in the U.S. this year. So we think just like earnings should help the U.S. stock market this year, we think it's going to help emerging markets as well. We also like the valuations over there. So we're still allocating a small amount of our equity portfolios in emerging markets. That's our best advice still at this point, despite the virus impact. So speaking of the virus impact, that's next slide, and then we'll bring it to a close here with a quick comment on the election. So, we look back at some of these prior outbreaks. A lot of them hit Asian economies pretty hard, and you see that the S&P 500 does a great job of shrugging these off, right? The impact on the U.S. economy and on U.S. corporate profits from these outbreaks has been quite modest. These are scary, and you never want to dismiss the loss of human lives. But in terms of the economic impact, they have been very well contained, and we think this situation currently will be no different. And you see here the stock market in really all these cases bounced, was positive in 4 out of 5 of them in the next month. But if you look out 3 and 6 months, in all these cases, the S&P 500 was higher. So we think this will be a repeat of these prior experiences, and stocks will go higher despite the uncertainty and how scary some of these headlines are. And then lastly, turning back to the election, and then I'll close. So, everybody wants to know how this is going to play out, and obviously we don't have any better idea on who's going to come out of the Democratic primaries than anybody else does, nor do we have any better idea of who's going to win in November. But what we do know is there are 2 relationships that tend to predict elections. One is the stock market performance a few months before, and that's what this chart shows. The blue dots show that the election was basically called by the stock market. So stocks up, incumbent wins, stocks down, incumbent loses. Okay, so President Trump wants the stock market to rally in August through October. That would increase his election chances. So that's what this chart shows. We had a few cases where it didn't work, but 20 out of 23 is a pretty good batting average. The other relationship I think that's worth noting is income growth. You've heard politicians say, it's the economy, stupid, right? The economy drives elections, how much money people have in their pockets. That actually can be proven with data. Take-home pay, the change in take-home pay, adjusted for inflation, is up about 1% right now. Historically, it has to rise about 1.5% for the incumbent to win, the incumbent party. So Trump's going to do what he can to push that number higher. Certainly, the tax cuts that he announced in his budget the other day, and certainly we know he's already cut taxes. That is certainly part of that, and certainly he wants to do everything he can to influence take-home pay from here. So take-home pay over the next, call it 9 months, is going to be a real important barometer in terms of President Trump's re-election prospects. So we'll be watching that really closely. We really don't have data on that yet because it's got to be, it's the change in the next 10 months or 9 months, I guess, of data, not necessarily what we've been seeing in recent months. So we'll be reporting on those going forward. They'll be really important to watch. And we might see, some people might think we should sell stocks because of political uncertainty. You do get a little bit of volatility on that, but it's kind of like these virus outbreaks or other geopolitical shocks. Historically, you get a little bit of a pullback maybe around the uncertainty, but then after that uncertainty clears, stocks tend to go higher. So I'll end on that note and turn it back over to you, Lee and Tim, for any closing remarks. And certainly we want to look at the important disclosures.
All right, we appreciate the insight, Jeff.
I'll turn it back over to you guys.
All right, great.
Thank you, Jeff, for your thoughts on the current market environment. As a reminder, if any of you have any questions, please contact us by calling 781-848-9821 or visit us on the web at www.leveroni.com. That's Leveroni.com. Also, we would like to hear some feedback to help us improve the format of these calls. Also, if you know of anyone who would be interested in hearing our market update, you can forward this email to them. Thank you for your continued confidence.